Welcome to this Measurabl hosted webinar on the top 5 climate risks in real estate transactions. We're really happy that you've joined us. My name is Sarah Anzinger. I'm Senior VP of Capital Markets at Measurabl and was formerly Director of our data product line. I've been with the company about 4 years, and most of my background has been in commercial real estate loan underwriting, originations, as well as workouts after the last financial crisis. So I've been around a little while. For the past 10 years, I've been in sustainable finance and spent time at GRESB and Fitch Ratings, and was really keen to join a tech company to further develop the climate and ESG data used to inform credible sustainable finance transactions, and to really see the sustainable finance market move from niche to mainstream. So I'm very happy to be here with you today. Before we dig in, I just want to follow up on a few housekeeping items. So we welcome your questions in the live Q&A. We will be responding to them offline following the webinar, given we have a very short 20-minute session with you here today and a lot of content to cover. The team will be monitoring the chat as well, and there will be a recording available after the event. So with that, just provide a very quick overview of our agenda. We'll cover some high-level market trends, frame the problem that we're going to be exploring today, provide an overview of Measurabl's solution, and a quick demo. So I just wanted to start by providing a snapshot of the current macro environment at a very high level, because I think this is relevant to our discussion. One is to focus on structural shifts that we've seen within the industry over the last few years. Post-COVID in particular, with the move to remote work, working from home, we've seen declines, or rather increases, in office vacancy rates. This has followed the trends that we've seen for a decade or more in retail and the move to online retail, and simultaneously an increasing demand in affordable housing. And so what you're seeing over here on the left-hand side is a nice, excuse me, a nice visual from McKinsey that basically shows the change in demand for those different property types over this time period from pre-COVID to projected out to 2030 across major global markets. And you can see that trend, and also what we see is increasingly developing building for modular flexibility, and also converting properties to different use types that are more in demand. So for example, office properties to residential. We're also living in this world of higher interest rates, right, after a long sustained period of a low interest rate environment. And the impacts, of course, have been higher cap rates, lower values, lower transaction volumes. And this makes for price discovery and liquidity challenges, as well as less access to debt capital. So the graph I'm showing at the top right is really just a representation from some data from MSCI and CBRE that shows over time the way transaction volumes have dropped from the peak in 2021. This is for the Americas in particular. And then, of course, climate-related regulation is another macro trend. The regulations are really intended to align to net zero targets by 2050 per the Paris Agreement, keeping our global warming temperatures to 1.5 degrees Celsius or less. And the real estate sector factors prominently in this equation, right? It comprises 40% of global carbon emissions are driven by buildings. The UN Environment Program says that 28% of that is driven by operational carbon, 11% by embodied carbon. And so as we look more closely at climate-related risks, these other macro trends really come into focus as well-timed opportunities. And so, for example, what better time is there to invest in or implement climate resilience measures than when you're future-proofing an asset and converting it from one use type to another, for example. We've also seen coming out of other market downturns, distressed buying opportunities, which have emerged and driven transaction volumes. And so this pent-up demand going into 2024 really makes for compelling value add opportunities that are ripe for energy efficiency and decarbonization retrofits to really take advantage of the upside to come, given climate considerations have not yet been fully priced into the capital markets. So let's go a little bit deeper into the top climate risks for property level transactions and how they translate into costs and impacts to value. And so we'll start with regulatory risk. Building performance regulations like Local Law 97 in New York or minimum energy efficiency standards in the UK, they've attached financial penalties to the energy and carbon performance of buildings. And so what does this mean in terms of cost or impact to value? Well, either one is paying the penalties and fines and potentially depleting reserves if not planned well in advance. This could also be seen by lenders as adding to a borrower's contingent liabilities going forward, and therefore impacting access to capital. But the other option is, needing to budget for CapEx in order to retrofit the building so that it's in compliance and the fines and penalties are avoided. The second risk is physical climate risk exposure, and hazards such as hurricanes, wildfires, flooding, sea level rise. Right, these are increasingly common. We read about this in the news. And as a result, property owners are seeing much higher insurance premiums in many cases, and even in some uninsurability. In fact, this has already become quite common in some regions where physical climate risk and hazards are exposure to that are particularly high. Thinking of coastal regions, for example, South Florida as an example. Third, energy performance. So this is kind of one of maybe the oldest tried and true climate risks, and that there's such a direct correlation and impact on expenses and value. So typically you see energy performance reflected in utility expenses and OpEx, and with the rising costs of energy in many parts of the world, which we've certainly seen here in Europe over the past few years related to the war in Ukraine, special attention really should be paid to energy efficiency when going into a transaction. Closely linked to energy performance, of course, is carbon, given within the building sector, it's derived from the energy use of the building during its operational phase. And carbon emissions are increasingly scrutinized, not only by regulators, but also by tenants who are looking for more efficient green buildings, investors, lenders, many of whom have set their own net zero targets and are, of course, incorporating GHG emissions into their investment and business decisions, as well as engagement strategies. So loss of competitive advantage in the eyes of these stakeholders is a further risk, and relative performance to peers is something to assess during transactions, as well as this climate regulated environment becomes more and more competitive building to building. So while we refer to these as climate risks, it's clear that this is about property fundamentals and impacts to value. And the challenge in addressing all of these really is the lack of timely, readily available data. So at the most basic level, the problem we're framing for you today is the lack of property level climate data among stakeholders who have no direct operational control of the assets they have exposure to. So these are parties who are suffering from the ongoing industry challenges around utility data access and sharing. Some examples, of course, would include lenders or debt capital providers who are conducting financing due diligence, but also doing ongoing loan portfolio monitoring, preparing to report on their own financed emissions. Lenders typically don't have access to actual or measured energy consumption data on the underlying loan collateral within their portfolio. Another example is, owners in early stages of acquisition due diligence, without full information, needing to move quickly, but also needing to be well informed. And there's still often data access challenges between even GPs and LPs, tenants and landlords, especially in sectors like triple net retail and multifamily residential. So the solution that Measurabl has really relies on limited inputs from that most indirect stakeholders have access to, and provides in return maximum outputs. The outputs are granular, they're property level versus company data. They are robust energy and carbon estimates produced by machine learning models that are trained on the highest quality data within Measurabl's database of over 100,000 assets across 90+ countries globally. And these are comprehensive estimates in that they are whole building energy and carbon. So what I mean by that is covering scopes 1 and 2, and also scope 3 tenant emissions. The data is fresh in that the estimates are refreshed monthly and trained on data that is constantly being refreshed and current, in other words. The solution is available on demand, and it's also delivered in a very lightweight 5 to 6 page PDF report that can be printed and included in investment and loan committees for internal discussion and decision-making purposes. So with that, I'm just going to pop into a quick demo for you here of Climate Due Diligence Scan. And this is our simple landing page. The inputs that I mentioned earlier that most any stakeholder would have access to that are required are property address, primary property type, floor area, year built. And with that, you just hit scan. And within about a minute, you would see when that scan is completed here, it would show up in your queue of all of the scans that you have created. And you would have access to that going forward and indefinitely. And pull it up here, and I'll just give you a quick walkthrough of what the deliverable looks like. So at the top, you can see a recap of the inputs. So you know which property we're talking about here, the date it was generated, and what you would see would be a visualization of energy use intensity across time coming up to year to date. So the solid line here is the estimated energy use intensity in relation to these dotted lines, which are benchmark data on similar properties of type and location. And the benchmarks are based on actual median energy use intensity data within Measurabl's database and are provided across a suite of benchmarks by geography, as you can see here. This data is further expressed in a table that breaks out percentiles. And so you can get a quick sense of what's being projected as of the most recent full year, 2022. You can see that this property is estimated to perform in the top 50% of similar buildings within the Northeast region of the US in this case. And we call out also top 15%, for example, which has relevance within Europe related to the EU taxonomy. So you get to see a range of what those kilowatt hours per square foot would require in order to be in which bucket. We break this out even monthly in case you're interested in that level of granularity, and we provide confidence labels and metrics for each of the estimates that we provide. You would see similar visualization and table for carbon estimates relative to benchmark. And then we also provide, as we talked about, regulatory risk for properties in the US and Canada. Are they subject to any type of ESG benchmarking, disclosure, or building performance ordinance or regulation? Here you can see we break those out separately. So you would know if some type of report has to be filed to disclose the energy or carbon performance of this building. In this case, indeed, looks like Local Law 97 is relevant here from a building performance standpoint, and we even would link to the legislation related to that ordinance. Is the building green building certified? So you can see here, we're pulling in LEED certifications that are relevant to the building, reflecting the certification type and level and the date that it was awarded. You have a bit of history here. We do the same for BREEAM if it's relevant. And lastly, we provide physical climate risk data through our partnership with S&P Global. So you would get to see 3 different time horizons and climate scenarios across these 7 hazards, indicating what are the greatest physical climate risks to this particular property. So in a nutshell, you would get a very lightweight report that would give you a sense of the climate profile, both from a transition risk and physical risk standpoint. And you could print or export this report and use it as you see fit. So that concludes our demonstration. And just want to close by saying that if you would like to learn more about what we've showed you today or receive a personalized consultation or demo, you can certainly contact us at sales@measurabl.com or through the QR code, which is on the screen. A representative will contact you and schedule a call at your convenience. Thank you so much for joining us today. We appreciate the chance to share this content with you and very much welcome further dialogue on your take on property level risks and opportunities and how we can work together to support one another in navigating those going forward. So thank you so much for your time today.